I define the Southeast, I'll define the Southeast as everywhere but Atlanta and South, say Miami Beach or South Florida, because those two markets are completely different. Trophy properties, really high quality properties, international investment in the Southeast really has been focused on those areas. And the only real reason that some of the bigger investors, institutional investors, even dropped down into the tertiary markets or the secondary markets of the Southeast was because there was no product available in the 24-hour cities or in the bigger markets. And so there was a pressure for that money to go somewhere. And so it began to make its way in. I mean, it was not very long ago that markets like Charleston, South Carolina, or Greenville, Spartanburg, South Carolina, or even Raleigh were being invested in at all by the institutional investors because they just felt like those markets were too small and they weren't deep enough that in case something ever happened to their tenants or their income flow, was the market deep enough to ever recover? And the traditional answer until the 2000s was no, they weren't. So money is what pushed those institutional investors into those smaller southeastern markets. It's significant now because now that we're trying to find a new normal, and everyone will have different underwriting standards and criteria, which should tend to make more sense based upon where your money is being invested and the safety of that investment, considering the risk management component of that, and probably a little bit less speculation on potential growth of net income or reduction of cap rates. Institutional investors, I don't think, will look at the Southeast the same. I think you'll see a lot less institutional investment in the Southeast other than in specific areas. So those rules, in my opinion, will be completely rewritten for the tertiary and the secondary markets. So who is active, who does have money that's waiting on the sidelines? Like I said, there's very little activity. There's a lot of money sitting on the sidelines. In the Southeast, most of that money is REIT money. Until the CMBS markets come back, and we're starting to see a little bit of flow back into the markets, but that's not going to land in the Southeast anytime soon, in my opinion. There is a lot of money on the sidelines, and they're waiting for that recognition of the quality assets that aren't considered trophy assets, which is the majority of the Southeast, but for those quality of assets to really get marked down to market and what they're really worth. So when you see a $25 million asset, which is probably about the average size of a decent asset in the Southeast, a $25 to $50 million asset, when you see that those have come down in value by 40%, and then when you begin to look at what the economics behind that investment are in terms of its ability to yield income over a period of time, and is it in a growing market, there's just, until we have a reckoning of this, of all the debt that's out there and all the assets that are underwater, no one's going to trade in those markets. So right now, it's a long story for a short answer. The activity is in distressed notes, mostly a lot of one-off note acquisition in the Southeast with the regional and the community banks. And in the trophy assets, the highest quality assets, we're starting to see some shopping centers, high quality shopping centers with good quality tenants turn. A lot of the medical REITs have been active in the Southeast. That's probably the one area the REITs have been active. So high quality assets, distressed assets, but mostly on the note basis, and everything in between is on the sidelines until we really see a true mark-to-market on that, until the banks begin to really recognize what they have and begin to act on those and release those. And it might mean some defaults and some foreclosures. Until those come out in the market, there's a lot of people sitting on the sidelines.